Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Jim, today we're going to talk about the recent rally in copper and how this is affecting the juniors in my favorites and bottom fish collection.
So what do you make of the recent copper price rally?
The current price rally seems to be driven more by hedge fund speculators than fundamental reality. You look at the Shanghai warehouse stocks, and they are more than nearly double those of the LME. Now, the LME stocks are considerably lower than they were before the China supercycle kicked in 2003, and again, substantially lower than they ended up between 2010 and 2015 after the supply mobilization caused by the China supercycle delivered more copper than was actually needed in a global economy that stalled when the United States failed to really engage in fiscal stimulus, and China's own investment, $700 billion investment binge, also ran out of steam. But the futures curve on the LME is interesting. It's saying that by end of 2025, copper will be about $4.76 per pound, declining to about $4.63 per pound a couple years later. Now, this is very different from the sort of $3 to $4 a pound range that copper has bounced around during the last few years. And that range has not been particularly good for juniors, which really need a price at this sort of level between $4.50 and $5 a pound. So the futures market is saying that the price for copper is going to be higher in real terms than it has been. But China's problems with its residential building boom that is stalled, the reason the copper stocks are piling up in the Shanghai warehouses is that China is not drawing them down at the rate they are used to. So this is not a case where, such as in the supercycle, where the physical demand outstripped the physical supply. This is more of an anticipatory rally. But there are good fundamental reasons for this to not be just a manipulative flash in the pan. The first reason is the requirements of the energy transition, which the IEA projects will require a 50% increase by 2030 in copper supply above and beyond what is needed for the macroeconomic growth that can be expected to meet the net zero emission goals of 2050, and most of this is earmarked for the electric vehicle technology. Now, at the moment, the optimism about how fast electric vehicles will be adopted, that has become somewhat subdued as everybody realizes that the cars that the global West car makers are making available just aren't there yet for mass adoption. And while the really cheap Chinese cars could possibly attract North American consumers, tariffs are being erected to prevent them from flooding the market because the government policies, they want the domestic car makers to get their act together, deliver the affordable cars with driving range and short charging times that will appeal to the average consumer who right now is not really interested in a Tesla type car, which has really been bought by the economic elites. And that's kind of run its course too, because Elon Musk has managed to damage his brand by adopting a very right-wing stance on everything, alienating the audience that has been buying his cars. So at the moment, electric vehicles, that sort of future demand for copper isn't really driving interest in copper. Now, a second reason for copper enthusiasm is the realization that the AI dream is going to require a vastly greater amount of electricity than capacity is currently installed to deliver. And in addition to that, there is the problem that even the dumbest bag of hammers can't help noticing that global warming is real and that air conditioning requirements are going to go through the roof as everybody deals with very, very hot summers. And air conditioners are also copper intensive, plus they're going to require more electricity. And now that Wall Street has adopted the cryptocurrency scam as something legitimate, the future energy requirements to keep the scam alive, that's also going to go up. So there's this general realization that electricity demand's going up, copper's linked to that, and because the whole AI dream is driven by greed rather than government policy predicting that if you make sacrifices now, something beneficial for future generations will eventually happen, something that nobody really knows. Greed is a much better driver. Now we're seeing the realization that copper is going to end up in the sort of $5 to $10 per pound range between 2025 and 2030 because new projects in the pipeline just aren't capable of delivering both the energy transition requirements or these new requirements that are arising from the AI dream. And this is why BHP is making a bid for Anglo American, because it realizes that this copper production is going to be a cash cow when the price goes up into the $5 to $10 a pound real range. Mobilizing new supply isn't going to be possible until 2030 and beyond. And another interesting development, I was just reading in the Financial Times today that a UK fund called Palliser Capital has started to agitate about Rio Tinto's dual listing structure. Now, Rio Tinto trades on the ASX and it trades in London, but they are different corporate structures. They are not quite the same thing, and the London version trades at a discount to the value of the ASX version. And what the problem that this activist investor is seeing is this prevents the complexities associated with this complicated structure, prevent Rio Tinto from offering paper in the manner that the BHPs and Glencores are able to do with their share structures. Rio Tinto can only pay cash to acquire assets. So this activist is saying, unwind this, have your primary listing in Australia, have a secondary listing in London, and enable Rio Tinto to offer paper, not just cash, because cash you need to borrow, and then you have your interest payments along with it. But if we're heading into a copper market, you want to be able to issue paper that's going to be attractive to the parties that are selling, not just cash. Now, neither Rio Tinto nor BHP have responded much to this move of copper from sort of below $4 to this $4.50 to $5 range, and that's because these companies are also very much the revenue base is in iron, and that which is not going to have any demand increase beyond normal macroeconomic growth. But you look at Freeport-McMoRan, it was sort of stuck in the $35 to $40 range in the first quarter. It recently reached a high of $55, and that's probably the best proxy for copper producers. So the market is, at least with the producer level, they are warming up to the idea of we're heading into a copper bull cycle. Now, the third reason to be bullish about copper is the changing supply structure of copper. Now, Chilean copper production came out of nowhere during the 1980s and absolutely dominated during the past couple of decades. But its growth has peaked. In fact, it has started to decline. And with the current president, Gabriel Boric, with his idea that the government needs to have a bigger role in the country's mineral resources, the chance that Chile will be able to increase its supply, that's probably not going to happen unless the country turns into an absolute dictatorship where the dictators can make everything happen by fiat. And Chile is probably not going to go in that direction. Now, the other new kid on the block is Peru. And Peru has become a significant copper producer, but its alliance, as a Global South member, its alliance is more with the Chinese. And this is going to be a problem for the United States, which is still the world's biggest economy, is that these countries in the Global South they're going to be switching their alliance to the global East countries, which are basically China, and Russia. Now, the other country that has been an emerging copper supplier is the Congo. And of course, Congo is inherently unstable, but the Chinese, they have their mitts in Congo, and they can assure that everything remains reasonably stable, but the price will be that the copper there will flow back to China rather than anywhere else in the world. So this is an emerging problem for the United States. China itself has become a major copper supplier. Last year, it provided 8.6% of production compared to the United States at 5.9%, which has been it's been pretty stable in terms of its supply, and the government policy hasn't really done anything to really help copper production. Even during the Trump administration, Northern Dynasty was unable to get the approval for the Pebble copper deposit in Alaska. In fact, Donald Trump Jr. weighed in against granting a permit for that. And this year, the Interior Department decided to ban a road that is absolutely critical to moving the concentrates from the Ambler project of Trilogy Metals and South 32 to a port where it can be sent to a smelter. And then there's the Deep Resolution Copper project in Arizona, which is currently stalled because of some Native American issues that are being allowed to keep this from happening. So the big elephant in the room is that if the United States ends up with, say, a Trump administration, and Trump pulls the plug on Europe and says, Putin, you can have Europe, and people say, well, he's a China hawk, but it is very unlikely that his isolationist instincts will cause him to do anything about China attempting an annexing of Taiwan. So we're looking at a situation where the United States could retreat unto itself, still be the largest economy, but suddenly have a problem in getting its raw material supply, of which copper is going to be an important part. And that, I think, has very bullish implications for resource juniors, because when you realize that the global south is shifting its allegiance to the global east axis, you're going to have to start looking for the copper in your own backyard. And your own backyard is going to be Canada and the United States. Forget about Mexico. Claudia Sheinbaum, AMLO's successor, she's completely against open pit mining or anything like that. And if there's going to be ever any more copper coming out of Mexico, it would have to come from open pit mines. So exploration in Canada and the United States for copper is an important thing for the future. And the company in my favorites collection is Hercules Silver. I adopted it on January 4th when the market punished the company when it published its last drill results related to the Leviathan discovery last year that had attracted a $23 million financing from Barrick at a premium to market. The stock has flatlined since then. It has not responded at all to the rising copper price, but there's two reasons for that. One, they didn't resume drilling until earlier this month with a 20,000-meter drill program that will start with 3 holes at 200-meter spacing, and that will test their new understanding of this copper system, this blind copper system. The drilling done last year was based on an IP survey. They expanded the survey and realized that the configuration is bigger and different from what they thought. So this year's drill program is geared towards exploiting this new understanding of what makes this system tick. So, but the other reason that the market, isn't really bidding up the stock now is because the audience that watches the resource juniors, just as with gold, it doesn't believe these recent price rallies are sustainable. It thinks these are going to be a flash in the pan. And this is where I see right now an excellent opportunity to buy a stock at a price that has sort of become a new equilibrium, awaiting better results, and a pricing that's not reflecting what is a secular bull market in copper. And, the standard view is, sell in May and go away, sit out the summer doldrums, come back in September, and when the results start pouring in and buy then. I think this year may turn out to be one of the exceptions to this rule, such as took place in 2010 when the market took off in July after they finally decided that all these mutterings about how copper was a flash in the pan, it's not going to stay high, all of a sudden they discarded that and we had a very big bull. And this also happened with gold at the same time. People finally started taking the gold price seriously. That, of course, ended a few years later when the oversupply of metal and gold ran out of its upside, and we ended up in this junior bear market. But I think we are on the cusp of a turnaround. We have a strong gold price. We have a strong copper price. We have reasons to believe that both are going to stay strong. And sometime in the next couple of months, we will see an inflection where the market starts to embrace these resource juniors.
Is anything happening with the copper juniors in your bottom fish collection?
I have 3 juniors in my bottom fish collection, which were favorites during the past few years, but because of circumstances ended up being demoted back into the bottom fish collection. Now, one of them is VR Resources, and that stock, its current focus is the New Boston copper project in the Walker Lane of Nevada. Now, this project was explored in the 70s by Conoco, an oil company. It had discovered this very large moly system. It is considerably lower grade than world-class deposits like Endako and Henderson, and they ended up pulling out when the oil market crashed in 1981-82, and that project has been sort of stigmatized as a not so good, a big but not economic or grade moly system. And during the past sort of 40 years, there has been almost no exploration done in that area. It's part of a major porphyry system. The eastern part's not well understood. There have been some holes poked in the area, but nobody has taken a serious approach in terms of teasing out, is there a copper system associated with this moly system? And this is what VR Resources has taken on. And they earlier this year, they developed a target. They did new IP geophysics that weren't available to past explorers, and they developed the East Zone target, which looked like this tubular zone of conductivity plunging to west towards this GW fault or structure that they see as somehow separating the moly system to the west and a potential copper system to the east. And for reasons that aren't very clear, nobody has ever poked some blind holes into this area to the east to see what's going on. So the market got pretty excited earlier this year with this 2-hole program that VR Resources undertook. They started drilling in early April, and only this week did they finally pull the plug on this hole at 600-meter depth and have started the second hole. And they put out an update, and the market was not happy with this update. The market had come to believe that this was a sniper kill shot. Here they had developed this geophysical target. They had all this circumstantial geochemical evidence in the periphery, and all you need to do was put a hole right down the throat, and it should come up with core bristling with chalcopyrite, the copper sulfide, and you would know right away that you have a barn burner discovery. Well, it turns out that the first half of the hole, the first 300 meters, went through country rock limestone that has been invaded with porphyritic dikes and sills that at one time did have sulfides, but all of it's been very oxidized so that you can't really see anything except the black-rimmed crystals from the oxidized material. And beyond that, they actually get into a monzonite porphyry intrusion, and there are sulfides there. But the drilling took forever because the rock is so broken up that drilling progress was very, very slow. So the market, when it got these results, it was disappointed because the company did not do any visual eyeballing of sulfides. They mentioned that sulfides were present, but they did not quantify it in any way. And that's understandable because you can't tell when most of it's oxidized. And furthermore, the deeper part, this is actually the first hole into this part of the system, and it has given a lot of geological information to Mike Gunning and Justin Daly. That probably isn't going to deliver an ore grade assay. What the market's going to be looking for is how fertile is this part with regard to copper potential. This is the first hole of what will turn out to be a vectoring strategy. So the stock got punished this week because the expectation of a sniper kill shot has now been wiped away, but it's actually created the beginning of a new interpretive framework for Mike Gunning and Justin Daly to pursue further. The second hole is 300 meters to the south, angling to the northwest to sort of cut through the target so they can see the fabric of the geology better and start seeing what's going on. Now, the interesting thing is, why, if the upper half is oxidized, why was it conductive? Because oxides are not going to be conductive. And it turns out there's an awful lot of clay alteration in the upper part. So it may be that the resistivity load that the IP survey picked up was actually a bit of a red herring, a bit of an illusion. And in a sense, this is good news because the model that they have developed is that this structural fault, this GW fault, is a gateway for the intrusions to have come up with. And because this whole limestone package has all been folded from much older thrust faulting from the west and compression, the planes of these folds provide channels for fluid flow. So this is not going to be your classic porphyry system. They do believe it is upright. There does not appear to have been any post emplacement. This system, the Moly system, is about 82 million years old. But where the copper ended up may not be your classic John Gilbert model of what a porphyry system is supposed to look like. And what they have now is enough geology to realize, wow, we have a multi-phase system. There are sulfides present. We don't know the copper content yet, but we have the beginning of what is going to be a major exploration play. And yes, we do not going to be able to deliver you a sniper kill shot barn burner hole, but the project is, I think, on a much sounder foundation now that they're starting to understand the geology. Now, another company that was on last year's favorites collection is Faraday Copper. And they ended up delivering a PEA last year that the market was not particularly happy with. This is the Copper Creek project in Arizona, which is part open pit and part underground. And they used a $3.80 as a copper price in the PEA, and that generated an after-tax NPV of $713 million at a 7% discount rate, and the internal rate of return was 15.6%, but the capex was $798 million. So this was like, you could tell they sort of pushed the numbers to put it close to development hurdles, but it wasn't really quite there yet. Now, what they did provide last year was alternative copper prices. They ran the model at $4.25 copper and $5 copper. But of course, until the past month or so, we have not seen $4.25 copper or anything approaching $5 copper. So the market has pretty much shunned the company. But at $4.25 copper, the NPV at the 7% jumps to $1.1 billion, and the IRR is up to 21%. And at $5, it jumps to a $1.8 billion NPV, and the IRR to 29.6. Now, nothing really has changed much with the cost structure of this system. So we are seeing this project has come from sort of being marginal at last year's $3 to $4 copper price range to suddenly being in the money. And that's why this week, the big development we saw, that's a sign that the institutional investors at least are starting to wake up. We saw Faraday do a bought deal of $20 million at 80 cents No warrants. Bought deal means that the brokerage firms are on the hook. That means that the only reason they do that is they know they can place the stock. But most interestingly, this was not like all these other horrible bought deals that we have seen in the past year, where the bought deal is done at substantial 25% discount to the market price, which is an instant hit to retail investors who own the stock, and it never bounces back from the bought deal price. No, this bought deal price was at the market. That is a strong financing. So this company is now geared, cashed up again with more institutional money on board, and it's ready to start waking up as the market starts to believe that these higher copper prices are the new reality. Now, the third former favorite is P2 Gold, which is the company that Ken McNaughton and Joe Ossoneca adopted in early 2021 after they left Pretium, which was a huge success. They were heroes. But what they found out when they started their own company, they plunged from being heroes to zeros. The institutional audience had evaporated. It wasn't interested, even though these guys had done great stuff before. It wasn't interested in what was going on. They took on the GABS project from Waterton. Waterton is this merchant bank which emerged in the past decade to hoover up all these sort of marginal deposits that the juniors were stuck with when the bull market ended, and they have been busy sort of farming them out or selling them to others. And the GABS project, it's in Nevada, and it is a copper gold system, and they had done a PEA last year, which, similar to the Faraday situation, was not very exciting. In fact, they even used base case prices above the actual prices because you needed that to have this thing meet the requirements. Well, they just updated their PEA and changed the mining schedule and that. It's kind of a gold-rich, front-loaded heap leach scenario with the cash flow eventually paying for the capex to build a sulfide mill to mine to process the copper-rich sulfides from these three deposits. And what's interesting is the PEA that they just updated, they used spot prices like $2,400 gold as an example and $4.71. And at those prices, the project at a 5% NPV has a $949 million NPV and $530 million at the 10% discount rate, and the IRR is at 33.5%. Has the market responded? No, it has not. The problem is the company has had to really struggle to deal with the terms of the Waterton deal, which had all these cash payments. And during the past couple of years, they've renegotiated several times. They are now only $250,000 in two payments at the end of this year, total, and the next year to have 100%. Waterton has converted much of these payments into convertible notes. It is now the largest shareholder with $23.5 million. Joe and Ken also own $20 million, but with the conversion from the notes, Waterton becomes the dominant shareholder for this company. So this is now a situation where Joe and Ken are agents for Waterton to continue to advance this project and bring it to a point where somebody wants to buy it. And again, it's a gold copper project in the United States with a meaningful copper credit. And their next step is to shift from PEA to go to feasibility study. This will take several years to do. They need to do a plan of operations and to do some of this geotechnical drilling they want to do. So for the next 6 to 12 months, not a lot will change with this company. They have abandoned all of their British Columbia projects that they had optioned on pretty expensive terms, and as this bear market dragged on and the exploration work they did failed to deliver the barn burner discovery hole, they ended up having to drop options such as BAM, and they'll probably drop Silver Reach. They dropped Todd Creek. They are now retreating full-time to the GABS project in Nevada, and their job is to continue to advance this and wait for the market to start to embrace that we are in a secular bull market for both gold and copper. And then when these mid-tier producers come along and want to come up with projects they want to develop, this is when something like P2 gold will end up being bought out at a substantial premium to the current sort of 14, 15 cent price. Full dilution it puffs up from 118 million to 205 million, but much of this dilution goes into the hands of Waterton, whose goal is to monetize this by having it being taken out. So again, the market in all these cases here, the market is not responding to the fact that we are entering a secular bull market for copper, and in the case of P2 gold, the gold also. And again, this is like a great period to be bottom fishing, and the time is now. Like it's almost June, and yes, the summer doldrums are coming, but be aware that the inflection, when people start taking this all seriously, could happen any time. And then these stocks will be very difficult to buy.
John, thanks for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.